This is Radio Cayman in the Cayman Islands.
Live from Radio Cayman Studio, this is
Money Sense, bringing an informed financial perspective to the Cayman community.
Good morning, Cayman. Adam Butler hosting today. This is Money Sense, brought to you by the CFA Society of Cayman Islands. I am the Chief Investment Officer of Resolve Asset Management. Today I've got my colleague Mike Philbrick, who is CEO of Resolve Asset Management. Mike is also a regular personality on BNN Bloomberg. And today we're going to talk a lot about the concentration in cap-weighted indices. Mike, we've got another $2 trillion market cap company on the books now.
Yeah.
What's going on?
Amazon just bolting through the all-time highs and good earnings reports, and a focus on tech and their AWS business. And so now we have another $2 trillion business. It's amazing the number of multi-trillion-dollar companies that now exist in the indices. I think when it first happened, I think it was Apple was the first one, or one of the large companies like that. It was sort of mind-numbing, and now you're like, it's just the normal course of business. Obviously, that causes some consternation within the performance of indices and creates lots of FOMOing for NVIDIA and Microsoft and companies like Amazon, but it has some real implications for individual investors, and should they eschew diversification in order to continue to chase the indices because all their friends are doing this, and it's a global phenomenon. I think you were looking at the concentration just in the global markets too of just how big the U.S. exposure has become. Not only U.S., but this is a global phenomenon. Yeah. Maybe you can share with everybody the
It really is remarkable, because you think if you're investing in a global equity index, you're getting all these different companies from Europe, from Canada, from South America, from Australia, from emerging markets, China, et cetera. What's remarkable is if you actually examine the underlying holdings of the, for example, MSCI All Cap World Index, which is the sort of most widely followed global capitalization weighted index, you're still looking at about 60% investing in U.S. equities in general. And within the U.S. equity market on a cap weighted basis, we have the most concentrated market ever. The top 7 stocks represent over 35% of the U.S. index, which means that they represent almost 20% of the global index,
right?
Which is, just unprecedented, right? So
every dollar everywhere that goes into a global pool of assets to be invested for the future
in equities,
20% of it goes into 7 companies.
Yeah,
like it's actually mind-boggling.
Yeah, it is. And what impact does that have? So if you attempt to diversify, so a really easy way to diversify is to sort of pick the top 500 stocks. So like the S&P 500. Mm-hmm. If you invest in the S&P 500, you're investing in the top 500 stocks by market cap. And that's up about 19% year to date. Now, if you were instead to invest in those same 500 stocks,
right.
But instead of going by market cap, where you've got all this overweight into these 6 or 7 big mega cap stocks, you're up in low single digits year to date. The gap is one of the widest ever that we've seen, going back to the early 1900s.
Yep.
And so you just can't get away from the gravitational pull of these NVIDIA, Microsoft, Amazon, Meta.
Yeah.
Mega caps, and if from an active management or a diversification or a prudent investor standpoint, it actually raises some really interesting questions.
Yeah, and I think I was reading as well, that at the moment, the 3-month correlation between the S&P returns and the number of stocks advancing dropped to the lowest on record. So just to say, 40% of the S&P stocks are actually down year to date.
Right. And the index is up almost 20%.
Correct.
Yeah.
So now square that with your advisor or you're an allocator. If you haven't allocated market cap, you are underperforming. And if you have diversified to other areas of the world or other asset classes, largely you are underperforming.
Yep.
And then if you try to do any sort of active management on top of that, there are actually regulatory limits to how concentrated you can actually be, and those regulatory limits provided by the Securities and Exchange Commission in the United States and global securities and exchange commissions across the world prevent the overconcentration in portfolios. And so, you're only able to get concentrated positions in about 25% of the portfolio, where you can have 5 or 10% in a stock, and that's a big position. The other 75% has to be no more than 5% per individual security. Those are the regulatory limits for mutual funds and ETFs that are active funds that are trying to create some sort of active share over the market.
So if you're investing with a typical mutual fund that is not defined as an index fund,
right,
you're subject to these regulations. The index funds are also subject to the regulations, but they receive exceptions, right? Exemptions from these regs. But if you're a typical active manager and you're looking at this market and you want to hold benchmark weights in these top 5 or 6 stocks, you actually cannot do it.
Yeah.
You are forced to underperform in this market. If all of the gains are coming from these stocks, you are, from a regulatory standpoint, forced to underperform because the regulators have deemed it as imprudent to have this level of concentration in such a small number of stocks.
Yet here we are with market cap weighted stocks, seven stocks representing 30% of the global, 20% of the global index.
Yeah,
I mean, it's insane.
And Meb Faber, a friend of ours who does lots of really great historical analysis of markets, came out with something very recently that showed that the only time we've been this concentrated in the top handful of names have been in 2007 before the crash. We were pretty close to this in late 2019 before the COVID crash. And before that, you go back to the sort of Nifty 50. And before that, you go back to the late 1920s before the Depression, right?
Yeah.
And really, his assertion was not necessarily that we should all be waiting for a crash right now, but more that the segment of the market that profoundly outperformed over periods with this level of concentration were actually the stocks that were not those big mega cap stocks. It was a sort of an equal weighted basket or even small caps that went on over the next 10 or 15 years to completely dominate the cap weighted indices.
Yeah, I mean, it does remind me a lot of the 2000 era and the NASDAQ tech bubble of that era and the concentration that occurred in the S&P 500. And, while it was in that high degree of FOMO phase where, you were just seeing the market march higher relentlessly, that's where people get that overconfidence from. That's when they start to performance chase. And then the last dollar goes in and the market cap market just kind of suffers. And in that case, it was 14 years before we saw new highs in the S&P 500. People forget about that in these times where they're FOMOing into the S&P 500. The simple thing to do in that period of time was simply move to an equal weight version of the S&P 500 or a more broad version of an all cap of the U.S. market, and you didn't have any correction. You had a few years.
You say simple, right?
Yeah.
And it is simple.
It's simple. It's not easy.
But it's not easy, right?
Right.
All your friends are getting mega wealthy by continuing to add to their positions in these mega caps.
Let's go back to the
time.
beginning
It
of
was
the year.
Cisco and Nortel and JDS
Sun
Uniphase
Micro.
and exactly. Pets.com.
Oh yeah, beautiful. But this is the thing. You hit the nail on the head, right? So it was a very simple thing to do in retrospect in 2000. And so why didn't we do it at the beginning of this year? Why didn't we say at the beginning of this year everything was so concentrated? Obviously, we should be in equal weight basket or we should be in small caps. Well, if you're in small caps, you're down 1% for the year.
Yeah, well, here's a wild statistic too, because I was looking at just sort of calling back to the MSCI World Index, the global cap weighted index. So MSCI also has an equal weighted version of the World Index. So it holds all the same companies, the largest companies in the world, but instead of holding them in their capitalization weight, they just equal weight them. Over the last 3 years, an investor seeking to be more diversified in their exposure to all of the global companies was up about 1% a year, annualized, whereas the cap weighted index where you're now holding all of these big U.S. tech companies and their concentrated allocations, was up 7% annualized over that time period.
Yeah.
This is a global index, and simply seeking to be more diversified has been unbelievably punitive. You can just imagine the grief that these, allocation boards of these big pension plans and these big sovereign wealth funds are experiencing at the moment as they're trying to be prudent and diversify across a broader basket of securities and asset classes. And their tracking error, underperformance to this global cap-weighted benchmark has just got to be excruciating. And I'm starting to see, too, in the commentaries of the CIOs of a lot of these big pensions starting to just fold and just say, I have regrets.
Right.
I wish, in retrospect, I should have been more invested in cap weighting.
Dumber. I should have been dumber.
Right. Yeah. Yeah. Which is the kind of capitulation you see towards the end of this, this kind of bubble.
It often intensifies at the end. If you go back to the bubble of 2000 in the NASDAQ, it was, up 20, then, in the final year up 100. You just go up in these leaps, and that curve just sort of straightens to the point it's almost bending back.
That's right.
And that's when everyone's just thrown in the towel, and they are, we've just got to be market cap weight, and we can't stand the performance drag anymore.
Yeah, exactly.
And here's the other thing, right? So on the one side, we see these equal weight, smaller cap, more geographically diversified portfolios underperforming. So there are two ways that can rectify itself. One is that those can catch up. So, it doesn't have to be a calamitous end. It could be that market cap weighted stocks go sideways for a while, but the rally broadens out and you get more breadth across the other stocks, and you see areas of the world other areas of market cap or geographical locations start to catch up. And you're seeing a bit of that. EEM, the emerging markets complex, broken out to new highs. It's not quite keeping up with the market cap weighted U.S. equities, but it's not horrible. You're seeing pretty interesting positions in gold do relatively well versus the market cap weighted stocks. So there actually are areas where it is competitive, or has been competitive. So it hasn't been too much of a cost or a drag, but it's certainly selective. So how do you go about selecting that allocation and not end up in the thing that is dragging the performance? But
yeah, exactly. Just to put some numbers on that, so a U.S. equity cap weighted is up about 19% year to date. Gold is up 15% year to date. And silver, I think, is actually outperforming gold at this point. Right. So the broader sort of commodity complex has been kind of lackluster, right?
Yeah.
Because it's mostly dominated by energies, which have been mostly flattish.
Yeah.
But the precious metals have really acted as a phenomenal diversifier and caught up or kept up relatively well.
And with the geopolitical framework that's happening in the world today, where you've got a conflict in Ukraine, and you've got the rattling of sabers around Taiwan, and all of these other issues, you've got an election we're coming into in the United States.
Yep.
So, I mean, there's certainly reason for more volatility to creep into the markets, and gold tends to do well in those types of geopolitical environments, as whether it's a hedge or something you can add to your portfolio to be a little different than stocks. Exactly,
yeah. So when we come back, we'll probably discuss, what's going on in the commercial real estate market too really interesting, and the big Blackstone fund, and just sort of the global setup here that might be favorable to gold. Yeah. And then talk about some potential ways to stack some diversification on your cap-weighted portfolios, so you don't really have to lose out on a further cap-weighted rally. You might be able to get that and your cake.
I want to dig into the paper you wrote on carry.
Yeah, right. Okay, we'll be back in a minute.
Hi, I'm Kathy Miller. Join me on Radio Cayman's Business Buzz every Tuesday and Thursday from 7:30 to 9 a.m. and the second and fourth Thursday of each month from 8:15 to 9 a.m.
Radio Cayman's Business Buzz.
If you're a business owner
or part of one, Business Buzz is your source for the latest initiatives, developments, and varied viewpoints from the local business landscape. Be part of the Business Buzz with me, Kathy Miller, every Tuesday and Thursday morning on Radio Cayman.
The Business Buzz. This is
Money Sense, bringing an informed financial perspective to the Cayman community. Brought to you by the CFA Society Cayman Islands.
And now, more Money Sense.
Okay, back to Money Sense. Again, Adam Butler hosting today on behalf of the CFA Society Cayman Islands. My guest, Michael Philbrick, Chief Executive Officer of Resolve Asset Management. We had just been talking about the incredible concentration in both global and U.S. stock indices that we're currently experiencing, which is a rare phenomenon. We haven't seen this level of concentration in a group of stocks since 2000. And before that, we only saw it maybe 2 or 3 other times in history. And they weren't very good examples of great entry points for equity investors. And so we now want to sort of talk about some of the other dynamics that are playing out in markets. One of the interesting things that is, I think, more of a page 10 story at the moment, but is, I think, maybe on its way to page 3 and eventually to page 1, it's what's happening to the commercial real estate industry. And there's been some interesting analysis out from some of Blackstone, a huge private equity, private real estate infrastructure, private credit group out of the U.S. And they have a extremely large, multi-$100 billion commercial real estate trust that is probably half of all global or U.S. institutions rather are investors in this CREIT real estate trust. And there's been some interesting analysis recently about how they're continuing to mark the value of their holdings. So just to sort of back up for a second, private investments are not marked to market based on the daily prices of what they hold, because the instruments that they hold, the real estate holdings or the private companies, are not traded on a daily basis. So they're valued by a group of accountants, right? Based on, a variety of rules. Yeah. Maybe if there have been a series of material transactions that are sufficiently similar to some of the holdings, then they'll try to mark them accordingly. But the accountants have been reluctant to move the pricing of the underlying real estate holdings in these big real estate trusts in the right direction to reflect some of the transactions. And these are large transactions we're seeing in major markets where, for example, pension funds who held large office buildings or apartment buildings, et cetera, in major centers like LA or Detroit have offloaded them for, like $1 because the debt that's owed on them outweighs the equity. And there's just no buyers for these items at current interest rates. And so these accountants continue to sort of price the underlying real estate holdings as if those holdings are not impaired to the degree that they would be if they actually were put up for sale at the moment, right? And the implications, given the fact that most of these properties are held on the balance sheet at a leverage ratio of somewhere between 2-to-1 and 3-to-1, right? So it doesn't really take much of a reduction in the mark on these properties to completely wipe out the equity in these. But the problem is that they're so large and they're so widely held by both private investors and sovereign wealth funds and large pension and endowment funds that everyone is more happy to kick the can and sort of extend and pretend, as they say, than actually having to mark to market and take the losses.
Yeah, it reminds me of a couple of movies you may have seen, either The Big Short or Too Big to Fail. So we're in the same sort of scenario where marking to market on the actual price is not happening at the rate it should. It's an extend and pretend. So everyone's working together. Now, it is a different market to a degree, right? So it's not like stocks and bonds where they trade on a market. The REIT is, but the positions within the REIT, the buildings, are not quite like that. So there is a lot of work behind the scenes in trying to extend and maybe pretend in some cases is too strong, but in some cases it's not too strong.
Yeah.
And then you've got the interrelated connectivity of these assets to pension assets, as you allude to, and it doesn't really benefit anyone to have a fire sale. The question is, can you manage through that in this managed way before something actually occurs where the straw that breaks the camel's back and causes the scenarios like in The Big Short, where they weren't getting mark to markets on some of the debt and things that were in that movie.
Yeah,
it's a similar thing.
It's a very similar thing, and the banks, the mortgage holders, the debt holders, the equity holders, the real estate holders, they're all sort of in the same boat.
They're in it together.
Wanting the same thing, right? Nobody wants the banks to be wiped out. Nobody wants the pension funds to be wiped out. And in the end, it's likely that governments will step in and ensure that this doesn't happen.
Yeah.
You can ensure it doesn't happen by guaranteeing the pension funds.
Yep.
Or you can step in and buy up some of the assets or buy up some of the loans against some of the properties. There's a variety of ways that this could happen. Either way, though, if the government comes in and expands its balance sheet, we're already in a wild fiscal position in terms of
More
deficits and the total aggregate debt outstanding, not just in the U.S., but in Canada, in Europe, in the UK. And the governments can, in theory, expand their balance sheets to infinity if they want. But the way they need to do that, if it's an acute situation, is by having the central banks buy bonds that are issued from the government directly in order to fund these asset purchases. So you can either have a reset in prices by allowing the market to operate and clear, which means that these assets on the books need to trade at their actual value. And many of these pension funds take a major impairment on their book values against their pension liabilities. Or governments step in and they bail out these institutions, and that dilutes the value of the currency. And this is a form of inflation, right? Where every dollar that you own just ends up not being able to buy as much
being
as
worth
it
less.
was. Yeah,
it's not worthless, but it's just worth less.
Exactly.
Yeah, and the EU took these steps in post the 2008 crisis and bought all kinds of bonds and said we'll backstop everything and everyone. And so it's not like these types of things haven't been done before.
Yeah,
it does sort of short circuit the Schumpeterian creative destruction opportunity that comes for the entrepreneur to take
we
assets.
left capitalism behind 15 years ago, if not 30 years ago, right? We're in sort of this weird nanny state where, if you are very close to the Fed and very close to sources of capital, then the government is at your beck and call. Sadly, if you're at the bottom of the income spectrum and you don't own financial assets, then there are fewer channels for the government to be on your side. We did see one of those channels in huge effect post-COVID, right? Where the government actually did fire hose money directly into everybody's bank accounts. Yeah. So that is absolutely a way that governments can help to bail out regular folks.
Yep.
But for the most part of the last 15 years, governments have expanded their balance sheets in order to bail out financial assets, right? Yeah. Which leaves a weird disparity in outcomes.
Yeah, I mean, it's the financial assets that are owned by the pensioners.
Right.
So there is a circle back in there, but it does benefit a lot of other people that have a lot more assets. Obviously, the 1% of the 1% of the 1% obviously benefit tremendously in those situations.
Exactly. Yeah. So, anyways, this is sort of an area of potential fragility in markets that could have some externalized consequences, either in the form of a reset in asset prices. Asset prices reset a little lower.
Yep.
Or in government balance sheet expansion and currency dilution, inflation. So there's like a market reset channel. There's an inflation channel. It'll probably be some of both. But it certainly then motivates this diversification push, right? Maybe you don't want to just have all your eggs in these risky equity assets that do really well when the government is backstopping everything and the economy is on a solid footing. Yep. But obviously you're very jeopardized if we actually have a regular business cycle or if governments allow natural consequences to occur for a change, right? So, that's where we get into maybe some alternative forms of diversification.
Right. So if you think through you've got traditional assets, and so you're going to diversify, your stocks for some disinflationary growth, some stocks for inflationary growth. Some economies do very well. Canada, Australia will do well in an inflationary period because of the natural resource component of the economy. So you want to go through your geographical type of diversification, your cross-asset diversification. So you're thinking through things like gold. Gold is sort of seeing the potential for this inflationary degradation of the fiat currency, and gold being a shiny metal that doesn't, you can't replicate it like you can replicate dollars.
Yeah,
it becomes more attractive. But then on top of that, you have to think through strategies that might be complementary to the asset pool. And so something that we've talked about many times before is trend following, which is a strategy that uses the price momentum in order to predict, future price. So if price is strong and going up, continue to own that, be long. If price is strong and going down, continue to short that, so you can profit from things that go down. But recently, you've written a couple of articles on the concept of carry, which is a very different concept, very complementary to both stocks and bonds, also complementary to a trend type system. And all carry looks at is it uses the yield of the product. In a very simple term, it uses the yield as an indicator of what future price would be. Now, the really nice thing about that is when you're using the yield as a characteristic of some future price prediction, you have a tailwind of that yield. So when you're looking at momentum and things like that, prices have gone up a lot, yield has gone down a lot. And so you're in a low yielding instrument thinking that it's going to go higher because it's gone higher in the past. And at some point that changes and you've got to change that position. You manage your risk and all that sort of stuff. But carry has this nice embedded yield. And sort of I liken it to the person that buys the dividend stock and they say, well, I'm buying the stock and I'm getting 5% to wait.
Right.
I'm just getting paid this 5% to wait. And if that 5% used to be 3% and it's historically high, and maybe there's some risks embedded in there for some reason, but at least I have this enhanced carry or yield in my portfolio while I'm waiting for that to reconcile. And how does it reconcile? Well, if yield goes down, price has gone up. And so it's a very complementary style. And you've just penned a much more simple version of it. It's on Return Stack Portfolio Solutions, just going through carry and all the different implications. So I'll throw it back to you.
No, I love it because it really, fancy, nerdy finance academics like to make up words, right? Which everyone else actually knows by another name, right? So, everyone understands carry as dividend yield in equities, right? They understand carry as coupon payments or interest payments on bonds, right? It just turns out that commodities also pay a dividend yield. It's the yield that is the cost of storage, or it is what the producers of commodities pay to ensure the price of what they're going to sell that commodity for at some time in the future after they build the mine, right? Currencies, it's just the difference in the yield between the currency you're borrowing in, say US dollars, and the currency that you're buying, say euros, right? Well, if the short-term cash yield on euros is higher than the short-term cash yield on dollars, then you can borrow in dollars and then go invest it in euros and then earn a higher interest rate on that, right? So it's just thinking about dividend yield from a broader perspective, right? You're just going from equities only or equities and bonds only into currencies and a broad basket of commodities. And so you're just getting this tailwind of yield from a much broader group of global securities.
And there's all kinds of reasons why those things will be there. Southwest Airlines has to hedge their fuel prices. So they're in the market buying fuel in advance of tickets because they're not an oil speculator. They're a seller of tickets and of airline tickets. And so they don't want to have that risk in their business.
Yeah, and ExxonMobil, it's going to take them 15 years to build a new oil field.
Yeah.
And they want to get financing to build that up front. They go to the market and they sell bonds or they sell more stock in order to get that capital. Well, the market likes to know that they're going to be able to sell that oil for a guaranteed price. So
Exactly.
they sell it forward, right?
Yep.
And on the other side of that is a group of speculators in futures markets who sell them that forward premium
Yep.
and earn an insurance premium on
Yep.
that, right? Anyway, that's Carrie. That's going to have to be it for today. Thank you so much for joining us. Thank you, Mike, for coming in and
Always a
sharing your
pleasure.
wisdom. And we'll see you back next week for more Money Sense.